Hello everybody, welcome back to the channel. I have an amazing video for you guys today. Check this out. This article is coming from Bloomberg.com and the article is called Shallow Recession Calls Are Totally Delusional, Roubini Warns. Now, I'm going to have a link to this article down in the description, but I kind of want to read over it because this kind of is setting the stage for a huge market crash. So let's kind of go over it. I'm going to read a little bit and kind of do my analysis as we go along. Now check this out. The two bullet points are: a reason Roubini cites is historically high debt ratios. This time it could be worse than the 70s, economist says. So here we go. Economist Roubini said that the U.S. is facing a deep recession as interest rates rise and the economy is burdened by high debt loads, calling those expecting a shallow downturn delusional. Now check this out, just before I keep going, you guys know that Walmart came out with their earnings and they're down. They were down quite a bit, and it's kind of bringing down the whole stock market, right? Literally the day before the Feds are going to raise the rates. So, that's not an indication. I don't know what is, but here, let's keep reading. Here's a quote. There are many reasons why we're going to have a severe recession and severe debt and financial crisis. The idea that this is going to be short and shallow is totally delusional. Among the reasons Roubini cited was historically high debt ratios in the wake of the pandemic. He specifically mentioned the burden for advanced economies, which said he continues to rise, as well as some subsectors. That differs from the 1970s, he said, when debt ratio was low despite the combination of stagnant growth and high inflation, known as stagflation. But the nation's debt has ballooned since the financial crisis of 2008, which was followed by low inflation or deflation due to a credit crunch and demand shock, he added. This time, we have stagflationary, negative aggregate supply shock and debt ratios that are historically high. So in previous recessions like the last two, we've had massive monetary and fiscal easing. This time around, we're going into a recession by tightening monetary policies. We have no fiscal space. This is terrible, terrible news. Basically, what it's saying is that we're at our limit and this is going to hurt like crazy. Basically, we have borrowed way too much. Not just the Feds, but just people in general. We are overextended. So any hiccup in the economy could send it tumbling down. So here, as I continue reading, concerns that rising interest rates will drive the economy into a recession has been escalating as the Fed tightens monetary policy aggressively to bring down the steepest inflation in 4 decades. Fed Chair Jerome Powell has said that failing to restore the price stability would be a bigger mistake than pushing the U.S. into a recession, which has continued to maintain that the nation can void. Powell and his colleagues are expected to approve another 75 basis point hike this week after raising rates in June by the most since 1994. Policymakers are also expected to signal their intention to keep moving higher into the months ahead. This time around, we have a confluence of stagflation and of a severe debt crisis. It could be worse in the 70s and post-CFC. So guys, this is kind of like a big deal article. Now, what if the economy does go down? We might have a strong housing market right now, and I could see why, because we have low inventory and generally we've had really low rates, right? So that is basically allowing a lot of people to be able to jump into the market, but because of the low inventory, it sent prices just soaring high. Unfortunately, our communities cannot support this high price for homes. So the problem is that it's gonna have to come down. Now, I don't think we have I know we're in a housing bubble because prices went up, like a lot of things went up, but I don't necessarily think the housing is going to be basically the first domino that brings down the economy. I think the fact that we printed so much money, that we have so much debt, and that rates are going up, and it's going to be more expensive to borrow, it's going to really tighten the neck on a lot of small businesses, a lot of businesses that have a lot of debt. There's a lot of companies out there that maybe they're using investor money, or they're just basically racking up debt. in order to get to a certain level where they could start being profitable. Well, I think a lot of those businesses are going to hurt really, really bad. Any business that, just has debt out there, remember that debt is going to get more expensive. And, when it becomes more expensive, the margins are going to be less and less. So that means, if you have a business and you're borrowing a lot of money, and the cost of money goes up, on the borrowing side, then when you go and sell your products, you're essentially going to be making less money, right? So if you're not set for if your company is basically not kicking ass, then you probably, there could be chances that it's going to get hurt, right? By this. So, and by that, it will kind of start bringing the whole economy down with it. So that's what we're looking at. I think that's what this article is about. Now, do you agree with it? Do you not agree with it? Personally, I do agree that we're in a lot of trouble, and I do agree that this is the trouble that we're in is going to help bring down the housing market to hopefully make it more affordable for people to buy a house. Now, if you have a W-2 job, it's very important that you save as much as you can. You lower your bills every month, because in about a year to 2 years, 3 years, you're gonna have an amazing buying opportunity if you wanna get into a house. But it's very important that you have that W-2 job, because it's a lot easier, a lot cheaper. You get a lot better rates when you have at least 2 years of W-2 income. So yeah, this is the time to save. Look, after you buy a house, whatever, you can do whatever you want. But for right now, I mean, the name of the game is just save as much as you can and lower your debt, pay off all your debt. That's, I'm not a financial analyst, but that's my own personal advice. Now, guys, if you like these videos, don't forget to smash that subscribe button and go ahead and like and leave a comment. Again, thank you guys so much for watching, and see you in the next video.